All right. So before we get started, we're going to run through a quick agenda. First and foremost, why should you even care about your credit score? What is your credit score? The 5 things you should know about your credit score, how to improve your credit score, and resources for managing and improving your credit scores. All right, so I'm getting started. So why should you care about your credit score? Here are a few reasons why you might want to care about it. Your credit score affects the following: whether you get approved or denied by creditors, the interest rates that you may pay on the loans if you're approved, better credit scores get lower interest rates, and just the overall cost of credit. The cost of car insurance in some states it's determined by your credit score. Deposits can be held on utilities. That's your cell phone bill maybe, or your cable. So if you have a poor credit score, they might hold a deposit. And then higher interest rates, if you have a poor score, higher interest rates lead you to paying more for the credit. So as a general rule of thumb, poor credit scores will cost you more, and it could limit your options. And I mean that you might have to settle for something instead of getting the item you really want. The next slide provides a visual representation of how a better credit score can provide you with more options. This is a generic credit score range. The point is, credit scores at the top of the range, they generally get lower interest rates, and they have the highest probability of getting approved. Poorer credit scores often lead to getting denied, higher rates, deposits being held, or the need for a cosigner. All right, so now that we've talked about the importance of your credit score and why it's important, what is your credit score? A credit score is a number based on analysis of a person's credit files. It represents their credit worthiness. FICO is the company that develops credit scoring models that most lenders use to predict your ability to pay back loans. FICO is used by over 90% of U.S. lenders. FICO has developed 28 different scoring models or types of credit scores, and it's used by all 3 major credit bureaus, Equifax, Experian, and TransUnion. So today we're not going to talk about the 28 different credit score models and types of credit scores. We're going to talk about the base FICO credit score. Base FICO credit scores range between 300 and 850. There are 5 ranges, as you can see here on this slide. 579 and below is considered poor. 580 to 669 is fair. 670 to 739 is considered good. 740 to 799 is very good. And 800 plus is excellent. So the bottom line here is that FICO scores are one of the primary factors used by most lenders to make credit decisions. Understanding how you're borrowing and your repayment history, it affects your scores, and it's essential to controlling your finances. You need to monitor your credit reports and scores and notice any changes. That way you can maintain good credit health. All right, so now I'm going to tell you 5 different things, 5 credit score components. These are the 5 pieces of information that you need to know. While we don't know exactly how our scores are calculated, we know there are 5 main components that go into it, and the 5 are your payment history, your credit utilization, your length of credit history, your credit mix, and any recent inquiries for new credit. And as we discuss each one of these, you'll see a question on each slide that you should think about. Your payment history is the biggest component of your credit score. It makes up 35% of it. Payment history tells creditors if you pay your debt on time. This is pivotal to lenders when deciding when to extend credit to you. So my question to you is, how likely are you to continue lending money to a friend that never pays it back on time or at all? I'm guessing you would not continue lending to that friend. Creditors operate in the same way. They're typically not in the business of lending to people who have no history of paying or paying on time. Next, we have credit utilization. Your utilization is the second biggest component of your credit score. It makes up 30% of your score. Credit utilization is looked at as a ratio of how much you owe compared to how much you have available. Let me give you an example of this. You have a $1,000 credit card, and for simplicity, let's assume that's the only credit you have. You spend $700 on that credit card. This means that you have used or utilized 70% of your available credit, because 700 divided by 1,000 equals 70%. As a general rule of thumb, you want to try to keep your utilization under 30%. Lenders look at utilization over 30% unfavorably. Next, we have your length of credit history, also known as your time on file, at 15% of your credit score. Your credit history shows how long you have responsibly managed credit. Here's the catch. The length or age of your credit history is determined in 2 different ways. The age of your credit file and the average age of the accounts on your credit file. The age of your credit file is determined by the oldest account's open date, which sets the age of the credit file. The average age is set by averaging the age of every account on the credit report, whether opened or closed. So think of it in these terms. Are you more likely to lend money to a friend you've known for years or someone you barely know? Next, we have your credit mix. Credit mix makes up 10% of your score. It shows how diverse your credit history is. Having a mix of credit account types and paying them on time can show lenders that you're responsible. Lenders will view you as less of a credit risk because you're demonstrating the ability to successfully manage different types of credit. There are three main types of credit. You have revolving credit, which is a line of credit that you can borrow against up to a limit. It usually requires monthly payments and interest charges for any remaining balance. Credit cards and home equity loans are the most common type of revolving credit. Installment credit refers to a loan for a set period of time with regular, fixed, occurring payments. Student loans, mortgages, and auto loans are the most common types of installment credit because they are for a fixed amount of time. Most of the time they're measured in months, and they have a payment amount that's due during this time. Open credit is the rarest form of credit. It is also, that makes it the least likely to be on your credit report. Open credit refers to accounts that can be borrowed up to a maximum, but must be paid in full each month. The most common type of open credit would be charge cards. So your credit mix means that if you can open and maintain different types of credit, maybe an installment loan and a revolving line of credit, it may help build your credit score. While it's good to have a mix of different types of credit, your credit mix is not the most important factor in determining your score. Remember, it's only 10% of your score. The remaining 10% of your credit score is made up by recent credit inquiries. There are two types of inquiries. You have a hard or a soft. Hard inquiries are credit pulls that remain on your credit report for 2 years and then factored into your credit score for 12 months. Soft inquiries do not impact your credit. These inquiries are typically initiated by companies doing a background check or pre-approving you for a loan. So it's key to remember that hard inquiries are typically initiated by you as the consumer, and soft inquiries are initiated by a person or a company checking your credit. Keep in mind, when creditors see a lot of hard inquiries on a credit report, they become more wary about extending credit because it makes you look like a consumer that is desperate or someone who is unable to get the credit they needed from other creditors. In other words, a lot of inquiries make you appear like a higher risk borrower. So it's best not to apply for any unnecessary credit. All right, so now that we've gone through the 5 components of your credit score, you're probably thinking, okay, so how do I improve my credit score? Improving your credit score is a process. It takes time. Be patient. Paying debt on time is the most important step you can take to improving your credit. This should be followed by lowering your credit utilization levels. These 2 steps are crucial because your payment history and utilization make up 65% of your credit score. Improving in these areas will have the biggest impact on it. Having a healthy mix of credit can also help your credit score. Staying on top of payments regardless of credit type shows lenders that you are responsible handling various types of credit. But remember, if you don't need to open a new account, it's not worth it. Just focus on maintaining good spending and paying habits on whatever existing credit you have. Your greatest friend is time. All right, so now, before I go, I'm going to give you a couple of great resources that you should check out. Credit Karma. Credit Karma offers free credit scores and credit reports from Equifax and TransUnion. They do not offer Experian. I would suggest you check out this site and check out what your credit score is. But LGFCU is also a great resource. Good news for LGFCU members: if you have an active loan with the credit union, your credit score is available on Member Connect, and it's provided quarterly. I would also highly recommend that you check out the personal finance section of LGFCU's website. We have a credit and loans category that has everything you need to know about loans, credit cards, and credit reports. Compass is also another great resource. It's our complimentary money management tool for LGFCU members. You can track your transactions, including credit cards and other loans, and see where your money is going. Compass is great for setting and sticking to budgets, so as you're paying down these loans and credit cards to improve your score, you can use Compass to track it. For more information on Compass, you can refer to your next resource, your financial wellness team. We are a great resource. We can help you with this topic and other personal finance questions that you may have. And you can email us at info@lgfcu.org. So this concludes my presentation today. I would like to thank you for taking time out of your day to view this presentation. I hope the information that I shared was helpful and makes you want to check your credit scores. Once again, if you have any questions or need to get a copy of these slides, send us an email at webinars@lgfcu.org. Also, be on the lookout for more webinars brought to you by your financial wellness team.